This is the moment America admitted it cannot afford to live. $1.23 trillion. That is how much Americans owe on credit cards right now. The highest level ever recorded. Higher than before the 2008 financial crisis. Higher than at any point in the 60 years we have been tracking this data. And it is not because people are buying luxury goods, it is because they are buying groceries. You thought the economy was recovering? You thought wages were rising? You were wrong. In this special report, we are going to break down the credit card crisis that is crushing American families. We are going to show you why people are drowning in debt just to survive. We are going to expose the trap that keeps millions stuck paying interest forever. And we are going to explain why 22% of Americans have given up hope of ever getting out. The numbers are staggering. According to the Federal Reserve Bank of New York, total credit card debt hit $1.233 trillion in the third quarter of 2025. That is up from $770 billion at the pandemic low in early 2021, a 60% increase in 4 years. The average credit card balance for people carrying debt is now $7,186. In Connecticut, it is over $9,100. These are not luxuries. These are survival costs that people could not cover any other way. But here is the number that should terrify everyone. According to Bankrate's 2026 survey, 61% of Americans with credit card debt have been carrying it for at least a year. That is up from 53% just 12 months ago. People are not paying off their cards anymore. They are making minimum payments and watching the balance grow. The interest rates make escape nearly impossible. The average credit card APR is now just under 24%. Some cards charge 29%, some charge more. At 24% interest, if you carry a $5,000 balance and make only minimum payments, you will be paying for over 20 years. You will pay more in interest than you originally borrowed. The compound interest works relentlessly against you. Every month, interest is calculated on your balance, including previous interest. The debt grows even when you pay. The hole deepens even when you shovel. A $5,000 balance at 24% with 2% minimum payments will cost you over $13,000 in interest alone before it is paid off. You will have paid nearly 3 times what you originally borrowed. This is not debt. This is indentured servitude with a plastic card, and it is getting worse. The Federal Reserve raised rates to fight inflation, which means credit card rates followed. People who could barely afford their payments before now face even higher costs. 22% of credit card debtors say they do not believe they will ever pay off their debt. Let that sink in. Almost 1 in 4 Americans with credit card debt has given up. They have accepted that they will die owing money to banks. They have surrendered to a system designed to keep them paying forever. This is not personal failure, this is systemic extraction. The causes reveal the real economy. When Bankrate asked people why they are in credit card debt, the answers were not vacations and designer handbags. 41% cited emergency or unexpected expenses, medical bills, car repairs, home repairs, the sudden costs that can derail any budget. 33% cited day-to-day expenses, groceries, utilities, childcare, gas, the basic costs of existing. This percentage is rising every year. More and more Americans cannot afford their regular expenses without borrowing. Think about what that means. A third of people in credit card debt are there because they cannot afford to live. Not live extravagantly, just live. The inflation story we have been told is incomplete. Yes, inflation has moderated from its peak. Yes, prices are not rising as fast as they were, but that does not mean prices went down. It means they stopped rising so quickly. If eggs doubled in price during inflation and then inflation slowed, eggs are still twice as expensive. Your grocery bill did not reset, your rent did not reset, your utilities did not reset. Meanwhile, wage growth has been uneven. Some workers got raises, many did not. And even those who did often found their raises eaten by price increases that came before. The result is a gap between what things cost and what people earn. A gap that credit cards fill. Credit cards were supposed to be a convenience, a way to buy now and pay later for things you could afford but did not want to carry cash for. They have become a lifeline, the only way millions of families can make it from paycheck to paycheck. The delinquency data shows the stress. The 30-day delinquency rate has been elevated for months. While it has recently dipped slightly, it remains near the highest levels since 2011. That is 15 years of supposed recovery, and people are struggling to pay their credit card bills like it was the aftermath of the Great Recession. Behind every delinquency is a family making impossible choices. Do we pay the credit card or the electric bill? Do we pay the credit card or buy groceries? Do we pay the credit card or fall behind on rent? These choices compound. Miss one payment and the interest rate jumps. Fall behind on rent and the eviction process starts. Let utilities lapse and the reconnection fees pile up. Debt creates more debt. Poverty creates more poverty. The hole gets deeper with every payment missed. Savings have collapsed. The personal savings rate fell to 3.5% in late 2025. That is down from 5.5% earlier in the year. Americans are not saving money. They are spending everything they earn and then borrowing more. Only 19% of Americans ended 2025 with more emergency savings than they started with. These were mostly higher income households. The people who need savings most are the ones who cannot accumulate them. 18% of people told Bankrate they never had any emergency savings at all. Nothing. No cushion, no buffer. One unexpected expense away from financial disaster. These are the people who end up on credit cards. Not by choice, by necessity. Because when the car breaks down and you need it to get to work, you do not have options. The generational breakdown is revealing. Gen X and millennials are tied at 53% for carrying credit card balances. These are people in their prime earning years, ages 30 to 61, and more than half of them cannot pay off their cards. This is not youthful irresponsibility. This is people with jobs, with careers, with families who still cannot make the math work. Even 36% of households earning over $100,000 carry credit card balances. This is not a low-income problem. This is an everyone problem. When people making six figures cannot pay off their credit cards, the economy is broken, full stop. The president proposed capping credit card interest rates at 10%. On the surface, this sounds helpful. Lower rates, lower payments, easier to escape debt. But economists warn it would backfire. Credit card companies set rates based on risk. Lower income borrowers, those with lower credit scores, get higher rates because they are more likely to default. If rates are capped at 10%, credit card companies will not lend to high-risk borrowers at all. They will simply reject applications. They will lower credit limits. They will cut off the people who depend on credit to survive. The people who can least afford to lose access to credit will be the first to lose it. This is the trap. High rates are crushing, but no access might be worse. People will turn to payday lenders charging 400% annual interest. They will turn to loan sharks. They will turn to worse. The problem is not that interest rates are too high. The problem is that wages are too low and costs are too high. The problem is that the gap between what Americans earn and what life costs has become unbridgeable. Credit cards are just the symptom. The disease is an economy that does not work for most people. What happens when the debt bubble bursts? In 2008, the housing debt bubble triggered a global financial crisis. Credit card debt is different, more distributed, smaller individual amounts, but the aggregate is massive. Banks that hold credit card debt are exposed. If defaults spike, their balance sheets suffer. If their balance sheets suffer, they tighten lending. If they tighten lending, the economy contracts. We have seen this movie before. Easy credit inflates, defaults accelerate, crisis erupts. Ordinary people pay the price while banks get bailouts. The difference now is that people are not borrowing to speculate on houses they cannot afford. They are borrowing to buy food. The debt is not from greed, it is from desperation. When the crisis hits, there will be no assets to seize, no houses to foreclose, just families who owe money they will never be able to repay, trapped in a system designed to keep them paying forever. 1 in 5 Americans with credit card debt believes they will never escape. Not pessimism, realism. They have done the math. They know what 24% interest means. They know that minimum payments barely cover the monthly charges. They know that the balance grows even as they pay. This is not a personal problem with a personal solution. Budget better is not the answer when groceries cost more than people earn. Get a side hustle is not the answer when people are already working multiple jobs. The answer is an economy that pays people enough to live without borrowing. The answer is health care that does not bankrupt families. The answer is housing that does not consume half of every paycheck. Until then, the credit cards will keep filling the gap. The debt will keep growing. And millions of Americans will keep waking up every morning knowing they owe more than they will ever be able to repay. $1,233 trillion, that is the number. That is the measure of how badly the economy has failed ordinary people. That is the weight-crushing 47% of all credit card holders. That is America in 2026. Drowning in debt, just trying to survive. Welcome to the trap. There's a history here that explains how we arrived at this moment. Credit cards were invented as a convenience for the wealthy. The original Diners Club card in 1950 was for businessmen who did not want to carry cash. It was a status symbol, a marker of success. The democratization of credit seemed like progress. Everyone deserves access to financial tools, the argument went. Why should working people be excluded from the convenience that the wealthy enjoyed? But convenience became dependency. As wages stagnated and costs rose, credit cards filled the gap. What was once optional became essential. What was once a choice became a necessity. The credit card companies know exactly what they are doing. Their business model depends on people carrying balances. They make money from interest, not from people who pay in full every month. Every feature is designed to encourage spending and discourage payoff. Minimum payments that barely cover interest. Rewards programs that incentivize purchases. Credit limit increases that arrive unsolicited. This is not a service. It is an extraction machine. It is designed to capture your income and transfer it to shareholders. The predatory lending that caused the 2008 crisis did not disappear. It moved from mortgages to credit cards. The victims changed. The extractors did not. What breaks this cycle? Higher wages would help. If people earned enough to cover expenses, they would not need to borrow for groceries. But wages have been suppressed for decades while productivity soared. Lower costs would help. If healthcare, housing, and education were affordable, families would have money left over. But costs in all these sectors have outpaced inflation for years. Stronger consumer protections would help. Limits on interest rates, requirements for clear disclosure, restrictions on predatory practices. But regulation is out of fashion in Washington. The most likely outcome is that nothing changes. The debt grows, the stress compounds, the trap tightens, until something breaks. Maybe it will be a recession that triggers mass defaults. Maybe it will be a political movement that demands change. Maybe it will be a slow grinding down of the middle class until there is no one left to borrow. $1.233 trillion is not just a number. It is a measure of desperation, a measure of an economy that works for creditors but not for workers, a measure of a society that has decided that debt is the price of participation, drowning in debt, just trying to survive. Welcome to the trap.